Welcome. In this lecture, we will consider some basic points and their application for the calculation of income tax liability, like qualifying interest payment, child benefit charge, personal loans and adjustment in personal loans, how much of personal allowance can be transferred between the married couple, and so on. So let's start with the basis of assessment. Individuals are actually assessed to their income tax on their income arising in the tax year. The tax year starts from 6th April 21 and ends on 5th April 22 for the Finance Act 21. How to compute the taxable income and individual income from all sources? From all sources is aggregated in a personal tax computation for each tax year. Here, the individual sources of income can be broadly classified as non-saving income, saving income, and dividend income. In the non-saving income, there are four heads: trading income, employment income, property income, and pension income. While the saving income consists of building society interest, bank interest, and also dividend income is said to be separately uh, presented, as the rates for the calculation of dividend income are different. So after adding all these non-saving and saving income plus dividend, you will get the total income. From this total income, you will deduct relief. Remember, there are two reliefs in your syllabus mentioned. First is said to be qualifying interest payment, and second, that relief you encounter is contribution to occupational pension scheme by the employee. After deducting relief from the total income, you will get the net income. Then you have to adjust personal allowance from this, and after deducting personal allowance from your net income, you will get taxable income. So this sequence is very important. From the total income, first you have to deduct the relief against total income, which is qualifying interest payment and contribution to occupational pension scheme. After that, you will get the net income figure, and from this net income figure, you have to deduct the personal allowance in order to find the taxable income. Non-saving income, as we have considered, trading, employment, property, and pension income are said to be non-saving income, while saving income are bank interest, building society interest, interest from company loan stock, interest from government stock, and interest from national saving and investment accounts. Exempt incomes are said to be income from national savings certificate, statutory redundancy money, winning including premium bond price, scholarships, interest on damages for personal injuries, local authority grants, and income from the investment made through individual saving account. Personal allowance, every taxpayer in UK is entitled to a personal allowance. This is a tax-free income that every taxpayer is entitled to each tax year. But remember that this amount can be reduced and potentially reduced to nil for high income individuals. Every taxpayer in UK, including children, is entitled to personal allowance, and for the 21-22 tax year, this personal allowance amount is 12,570. Remember, for the TX examination, means for F6 examination, the personal allowance should always be deducted from the taxpayer's net income from different sources in the following order. First, you have to deduct the personal allowance from non-saving income, then saving income, and then dividend income. Remember, this is the order for the F6 paper. In P6 paper, this will be changed. Assessable persons are every individual, including children, are chargeable to income tax, and if they are both spouses are considered separate individual for the purpose of income tax. Special rules are there for married couples. If they own some property jointly, then the income from that property will be split 50-50 ratio between the spouses, regardless of actual percentage ownership. Means if spouse A is 70% owner of a property, while spouse B is 30% owner of the property, but their income is normally treated on the basis of 50-50%. The rent from that building will be treated as 50-50%. Although they have election choice available, if they choose a different ratio, they can do so. Children under the age of 18 are taxable person. How to make adjustment to personal loans? For this, first you have to consider the adjusted net income, because adjustment to personal loans is based on adjusted net income. Adjusted net income is said to be amount that is calculated by subtracting donation under gifted scheme and contribution to personal pension fund from the net income. When you deduct these two amounts, and remember that gross of these amounts would be deducted from net income, you will get adjusted net income. Remember that in the format, you have to choose this net income, and from this net income you have to deduct gross personal pension fund contribution and gross gifted donation in order to find the adjusted net income. Now the stepwise approach to calculate or the adjustment in the personal allowance. But first, that when you have to adjust the personal allowance. If the adjusted net income is in between 1 lakh to 1,25,140, you have to adjust your personal allowance. Means if your adjusted net income is up to 1 lakh, the full personal allowance is available, and if your adjusted net income is 1,25,140 or greater than that, then no personal allowance is available for high individual earner. So if your income is in between 1 lakh and 125,140, you have to adjust your personal allowance. For this, in the first step, you have to identify how much of your adjusted net income is in excess of 1 lakh. Then the above portion of 1 lakh is divided by 2, or you can calculate the 50% of that amount, and then this amount will be reduced from the 12,570 of personal allowance. For example, if an individual has an adjusted net income of 1,10,000, first we have to identify how much of this is in excess of 1 lakh. This is 10,000. Divided by 2, you will get 5,000, and this 5,000 will be reduced from the personal allowance of 12,570, and hence the adjusted personal allowance would be 7,570. So in this regard, you have to consider the different points, like if the Tom has employment income of 1,15,000, what will be the adjusted personal allowance, and if it has income of 1,23,000 then, and Mary received employment income of 1,30,000, while she also made a gift donation 18,000, then how to calculate the adjusted personal allowance. The tax rate for the year 21-22 are up to 37,700 of your income will be taxed at 20%. Between 37,701 to 1,50,000 of your income, it will be taxed at the rate of 40%. Remember, these are the rate of income tax for non-saving income. For above 1,50,000 of income, the tax rate is 45%. Then there is an example. Jack has a taxable income of 30,000 and employment income of 3,000. How to calculate his tax liability? Here the total income of Jack is 33,000, and as there is no contribution to gross gifted donation or personal pension fund, it means the same is said to be your adjusted net income. And remember that if adjusted net income is up to 1 lakh, there is no need to adjust personal allowance. So full personal allowance is available, and after the deduction of personal allowance, you will get the taxable income of 20,430. As this income lies in the basic rate band, so you have to calculate tax on this at the rate of 20%. What if the Jack has a trading income of 60,000 and employment income of 6,000? In this example, the total income becomes 66,000. So again, there is no need to adjust the personal allowance, but his income is more than the basic rate band. Then how to calculate the tax liability? First, you have calculated his total income, deduct personal loans from that, and you will get the taxable income of 53,430. Out of this, first 37,700 will be taxed at 20%, and remaining portion, which is in excess of 37,700, will be taxed at 40%. Now Jack has an income of 1,60,000 and employment income of 6,000. So his total income is 1,66,000, and remember that if a person has a net income of adjusted net income of more than 1,25,140, there is no personal allowance available to him. So personal allowance 0, and the taxable income is again 1,66,000. Now you have to use the 3 rate bands. Up to 37,700 income, this is taxed at the rate of 20%. From 37,700 to 1,50,000, this portion of income is of 1,12,300, and it will be taxed at 40%. And above 1,50,000 of income, in 16,000 of above income will be taxed at 45%. An important point is that the effective rate of tax on income between 1 lakh to 1,25,140 is 60%. The 20% increase is due to the loss of personal loans. So if you are going to calculate an income of a person, if you are considering an income of a person as 1 lakh, then what will be his tax liability? And if he is receiving a bonus of 25,140, his total income becomes 1,25,140. What will be the tax liability of that person? In first case, his taxable income is 87,430, and on which tax is calculated as 27,432. And when his total income is 1,25,140, there is no personal loans. So you have to calculate tax on the 1,25,140 of income, and this tax liability is 42,516. Here we need to consider that the increase in income is 25,140 and increase in tax liability is 15,084. Means you are paying 60% of your increase in income as your tax when it is 1,25,140. Marriage allowance is allowed to couple, but it is restricted up to 10%. No doubt 10% of 12,570 is 1,257, but for the Finance Act 21, it is mentioned in Finance Act as 1,260 of personal loans that can be transferred. So if you are going to decide to transfer a personal loans between the spouses and the civil partners, you have to remember it is the fixed amount of 1,260 that you should transfer. Next is the difference between income tax payable and income tax liability. Employment income is received by individual after income tax has been deducted from his salary. The employer in UK is required to deduct income from employment income under pay as you earn scheme and paid to HMRC on the behalf of employee. So income tax payable is the income tax liability less any tax that has already been deducted from his taxable income through pay as you earn. Relief against total income. This is the relief which reduces your total income. Relief is available by deducting the payment or losses from the total income, and maximum amount of relief should be provided. The only payment deductible from total income which are examinable in TX examination is certain qualifying interest payment. Qualifying interest payment, for this you have to identify what are the qualifying purpose. If these qualifying purposes are mentioned in your question, then it means that interest payment for these qualifying purpose is said to be qualifying interest payment and are considered as relief against total income. Qualifying purposes are loan to buy plant and machinery for use in partnership or employment, loan to invest in partnership either in the form of loan or capital, loan to buy interest in employee controlled company, and loan to invest in cooperatives. These are the four qualifying purposes, and if for these purposes you have taken a loan, then interest payment on these qualifying purpose will be considered as relief against total income. Like Mary has a total income of 65,000, none of which is saving or dividend income. She made interest payment totaling 4,000 on his mortgage for his main private residence. If she has taken loan for the main private residence, this is not the qualifying purpose. So, interest paid on this loan is not deducted from the total income. Next, Roger has total income of 65,000, none of which is saving or dividend income. But Roger made interest payment of 4,000 on loan to invest in partnership in which he is a partner. So, we have considered here the second point, that loan to invest in partnership either in the form of loan or capital is a qualifying purpose. So, interest payment made by the Roger is considered to be the relief against the total income. So, in this case, Roger's tax liability would be reduced by the relief, but Mary's tax liability would not be reduced because her purpose of loan is not a qualifying purpose. Now, it is about gift aid donation. One-off and regular charitable of gift of money qualify for tax relief under gift aid scheme, but it is necessary that the donor gives the charity to a gift aid declaration. A gift aid donation is treated as through it is paid net of basic rate tax paid. Means if you are willing to pay £1,000, you have to pay 80% of that. Means you have to pay 800 as a individual taxpayer, and remaining 20% would be paid by the tax authorities on your behalf. Also, relief is given to the personal tax computation, and how the relief is given? The gross amount of gift aid donation increase your basic rate band or additional rate band. This is the way relief is provided. The gross amount of gift aid donation would increase your rate bands. How? Let's consider that. Shally earned a salary of 1,20,000. In January 22, she made a gift aid donation. Required. Compute Shally's income tax liability if that donation is a gross amount. And what if it is a net amount? So, first we are considering if Shally is donating a gross amount of 4,000. First, you need to consider her salary is 1,20,000. In order to calculate the adjusted net income, you have to deduct gross contribution to gift aid donation from your total income, and it will be 1,16,000 now, right? Now you consider that, remember that point, if your adjusted net income is in between 1 lakh and 1,25,140, you have to adjust your personal allowance. For this, you have to identify excess portion of adjusted net income in excess of 1 lakh, which is 16,000. Divide this by 2, you will get 8,000, and this 8,000 will be reduced from your personal allowance of 12,570. So, hence your personal allowance will be 4,570. This is the first implication. So, you have to adjust the personal allowance of 4,570 and your taxable income is 1,15,430. Second implication is that your basic rate band would be extended by the gross gift aid donation. Means now your income up to 41,700 will be taxed at 20%, right? So, this is the implication of this particular donation. 41,700 of your basic income will be taxed at 20% and remaining will be taxed at 40%. Same is the case where the where the contribution is net, but in this regard you have to calculate the gross amount, because it is the gross amount which is always deducted from the net income in order to calculate the adjusted net income. So, first you have to divide the net amount that is paid 4,000 by 80% to make it gross, and it will be 5,000. Now, the full treatment, same step would be followed but for the 5,000 amount. Jenny has a trading income of 1,30,000, gifted donation 8,000. You have to calculate what are the effects of this gifted donation. But remember that if the wording is used, she paid a gift aid donation, it means she is paying the net amount, and you have to convert it to gross amount. Now it is about child tax benefit charge. Child benefit is a tax-free payment from government that can be claimed in respect of children. However, a child benefit income tax charge arises if an individual receives a child benefit and he or she or his or her spouse or his partner whom she is living with, as if they have married or in a civil partner, has adjusted income of 50,000 or more. Or you can say that if the adjusted net income here is between 50,000 to 60,000, you have to calculate the child benefit charge. Means, in other words, if a person is receiving child benefit and his adjusted net income is up to 50,000, there is no tax liability for him for this child benefit. But and other point is, if his adjusted net income is 60,000 or above, then 100% of child benefit that he has received will be taxed as child benefit charge. But if the adjusted net income is in between 50 to 60,000, you have to adjust the tax benefit charge. So for this, again, the stepwise approach is you have to identify the excess adjusted net income in excess of 50,000, then divide it by 100, and the resultant figure is the percentage on which the child benefit charge is calculated. So for this, we will consider that an example, if a person has received a child benefit of 2,000 pounds, right? And his adjusted net income is 53,000. So we need to find out what amount of child benefit will be taxed. So first, for this, we have to consider the amount of adjusted net income in excess of 50,000, and that is 3,000, right? Divided by 100. In the second step, divide this 3,000 by 100 and you will get 30. So what you have to do, 30% of 2,000 will be directly added to your tax liability. So here 600 will be added to your tax liability. So remember that if a person has adjusted net income between 50,000 to 60,000, he has to adjust his child benefit charge.